G'day folks, welcome back to another update for Bitcoin. Now it's continuing to decline on the time frames, and I'll go through the charts in a minute. Also going to include some back testing. Make sure you hit that like and subscribe button to support the channel. In terms of the outlook, as of today, March 17, Bitcoin's fundamentals are influenced by several key developments. President Trump's executive order to establish a strategic Bitcoin reserve using seized assets has tempered investor expectations, leading to a recent price decline below $82,000. Analysts caution about potential further drops to $73,000, emphasizing the need for prudent risk management. However, institutional interest remains robust, exemplified by firms like Strategy's substantial Bitcoin acquisitions. This institutional engagement underscores Bitcoin's enduring appeal as a digital asset despite current market volatility. So first we start to look into long-term trends, and it depends on what time frame you're trading. You need to look at the higher time frame for that trend. So if you're trading on the daily, we look at the weekly trend, and at the moment you'd be predominantly going short. And likewise, if you're trading on the weekly, we look at the monthly. Now notice on the monthly here, the price is still above the moving averages, giving us a bullish signal on the monthly. But note the CCI is actually broken down into that moving average range. In fact, the moving averages have actually narrowed, indicating a potential reversal in the coming weeks possibly, or it's actually already bearish, but on the monthly at least, it may start turning bearish as well in the coming weeks. You want to see a widening of the moving averages like it was back here, and the CCI breaking high above those moving averages. And that generally flows with the price action, giving us a bullish signal. At the moment, it looks like it's reversing, and so obviously, as I said, on the weekly, it's already broken down below the moving averages of both the price and the CCI. So bearish movement on the weekly, and on the daily, it's been bearish now since probably around about end of November. Hit that peak near 110,000, and now it's dropped below. It's dropped around about 82 at the moment, 82, 83 at the moment on the daily. So I've drawn some support resistance lines here, like support resistance line actually. So I've got the resistance at 108.263. You hit that a couple of times, and now it's currently pulling back towards this, what was previously resistance, now support at 66.440. Now in terms of a pullback, you'll notice here we had a bearish divergence on the daily. So lower highs on the CCI versus higher highs on the price, and the price hit that resistance, as I said, twice before it finally started collapsing. It actually hit this immediate 23.38% Fibonacci level, which is what we look at as a potential, as an initial retrace, and that's 23.38% level, and currently it's sitting around a 50% level resting there. So the next level to look out for would be the 61%. And it may go further declining from there. So at the moment, that bearish divergence has worked on the daily and is still declining. Now if we go to the intraday chart, again using the daily as a reference, if you're trading on the hourly, you take short trades only. Now we had a couple of bounces here, but notice back here we had a bullish divergence, higher lows on the CCI versus lower lows on the price. That hit our 23.38% level. In fact, it went as high as, or actually broke through the 61% level. And then it quickly retraced back down and then fluctuated a bit in that range, and then it bounced again off the 61%, and it finally collapsed from there. Now since our last video, we've had a bit of a slight bullish move on the hourly, but I wouldn't be taking long trades. My strategy always follows the trend of the higher time frame, in this case the daily, if you're trading on the hourly. So we only take short trades. At the moment, you'll notice the 1 hour CCI and price are below the moving averages. So what I've got here is the back test for the stop loss strategy and the back test for the average down approach. And what we've done is we've started the back test from the point where that was around about February the 3rd. And that coincided with this on the daily, where the CCI was bearish below the moving averages, and that fresh break on that candle there on the daily, where the candle broke below the moving averages. We started the back test from there, and you'll see the overall. If we stayed in the complete trade, each of those trades on the hourly, it would have generated 7,700 for the stop loss approach, and for the average down approach, it generated 150,090. So the baseline for each of those is 100,000. So again, it would have generated 7,700 versus 150,000 for the average down approach. The reason that's so, I suppose, profitable on the average down approach is because it averaged down, we had multiple contracts, and it maxes out, in this case we max out at 15 contracts, we don't add any more, and we average down, we start off with one contract, and when it declines by, on the hourly, by 0.005%, at least that many declines, then we add two more positions. So we double the first lot of entries. So if the first lot is one contract, then we double that to two. So the next lot of contracts will be three. Let me just zoom into one to give you an example of what it looks like. So let's look at this period back here, for example. So we started off with one contract at that point. We stayed short. Now we only close out the position, excuse me, we only close out the position once the daily breaks into that moving average range. So we let the hourly run and let it run its course. Now in this case, you would have closed it out there according to that. I've marked that with a cross, and that signifies it by that point there. But I'm just demonstrating how many, how you average down. So one contract entered initially, multiply that 1 by 2, so add 2 plus 1 is 3. So, and then you got 2 times 2 is 4. So now you got, at that point, you got 7 contracts. Multiply that 4 by 2, you got 8. So 8 plus 7 is 15. And that's where it maxes out at 15. You can keep adding to it, obviously, but I prefer to max it out at 15 and always close it out and stop it if the CCI closes in that moving average range on the daily. So let the hourly run and let it, again, focus on the daily when you're trading on this. The same principle applies if you're running on the daily process, but you're looking at the trend on the weekly, except instead of taking a 0.005% drawdown before you average down, you give it a 5% drop. So obviously the percentages change depending on the time frame. The same happens in reverse. If the daily is going long, like during that period on the daily, you would have taken long trades on the 1 hour time frame. And notice on the stop loss approach up here, that's just basically entering for the same condition when the CCI and the price is below the moving average. You would have taken a short trade, and this one would have closed out with a stop loss. So a couple of these were profitable up until that point there on both of these strategies. You'll notice here, this one averaged down, and this one, or a couple of these here, you can see there the profitability dropped off on the stop loss approach. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you got a total of 3 contracts now running, add another 4, you got a contract, 7 contracts running, add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again stop loss when the CCI 150 turns into the moving averages. Obviously you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.